Welcome to today's deep dive on payment apps and personal finance safety. First, we will set the stage by exploring the controversy. Are digital wallets safe places to store your money? Then, we will unpack expert guidance, key risks, and a clear action plan to protect your funds. Stay with me as we move through real-world scenarios, comparisons, and a quick quiz to lock in your understanding. Before we dive deeper, here's our roadmap. First, we'll examine the core controversy and why people get locked out of their funds. Next, we'll define the pass-through principle and why experts recommend it. Then, we'll discuss the uninsured risk of digital wallets compared to banks. After that, we'll outline a practical action plan, compare banks versus wallets, and walk through freeze scenarios. Finally, we'll do a short quiz and wrap up with key takeaways. Before proceeding, a quick disclaimer. This content is educational and should not be treated as financial, legal, or tax advice. Your situation may be unique, so consult a qualified professional before making decisions. Now, with that responsibility note in place, let's continue to the controversy at the heart of payment apps and your cash. Let's begin with the controversy. Many users love the speed and convenience of payment apps, but there's a recurring problem: sudden account limitations. These restrictions can arrive without warning and may lock you out of your funds for weeks or months. Reports frequently mention minimal explanation, long review cycles, and confusing support paths. As we transition, this leads to a crucial question about whether you should store money in a non-bank digital wallet at all. Here is the core question: should you ever keep a meaningful balance inside a non-bank payment app? According to financial security experts, the answer is no. Instead, you should treat these platforms purely as pass-through tools. Receive funds, then transfer them to your insured bank account. The reason is straightforward. Many digital wallet balances are not protected by government deposit insurance, and policies can enable sudden freezes or inaccessible funds. Next, let's unpack the pass-through principle so you can operationalize this approach. The pass-through principle is simple. Use the payment app as a bridge. When you receive money, transfer it right away to your insured bank account. If auto transfer is enabled, the funds move with minimal delay. If not, balances can sit and be subject to reviews, flags, or freezes. As we move forward, let's convert this principle into a specific, repeatable action plan. Now let's translate guidance into actions. First, enable instant or at least daily auto transfer to your bank. Second, verify and link an insured bank account you trust. Third, maintain a zero-balance policy across all third-party apps. Fourth, set alerts to confirm that transfers have arrived. Fifth, keep documentation such as invoices, messages, and receipts in case of disputes. Finally, review terms of service periodically as policies can change. Next, we'll visualize how funds can get stuck to better understand the risk flow. This diagram illustrates the journey of funds from receipt to final destination. First, the user receives a payment that initially rests in the wallet. Next, a decision point checks whether an automated review is triggered. If the review is triggered, the account can be flagged, leading to a freeze. From there, the user enters an appeal loop that may result in either release of funds or continued inaccessibility. However, if no review is triggered, the funds auto-transfer to the bank, where deposit insurance typically applies. This flow makes clear that the safest path is to minimize time held inside the wallet. Now let's address uninsured risk. Many digital wallet balances are not protected by government deposit insurance. This means that if a platform experiences technical failure, policy disputes, or regulatory action, your access to funds can be restricted without the safety net you'd expect from a bank. By contrast, banks generally offer deposit insurance up to certain limits and have clearer, regulated processes. As we proceed, we'll compare banks and wallets directly to highlight these differences. Let's compare banks and wallets. On the bank side, you typically have government-backed insurance, regulated dispute processes, and a lower chance of arbitrary freezes. Banks may also provide interest or bundled services. On the wallet side, you gain speed and convenience, but terms can change quickly, and automated fraud systems can freeze accounts. Importantly, many wallets are not insured against platform failure, leaving your funds exposed. With this contrast in mind, let's look at common freeze scenarios. This table summarizes frequent freeze scenarios. First, a chargeback dispute can reverse payments and restrict your access, with protections depending on platform policy rather than deposit insurance. Second, automated fraud flags may freeze accounts until manual review is completed. Third, regulatory audits of a platform can lead to broad freezes that affect many users at once. Fourth, identity verification mismatches can lock accounts until proper documents are resubmitted. Across these cases, wallet balances typically lack deposit insurance, reinforcing why funds should not remain in the app. This pie chart breaks down typical drivers behind account freezes or fund holds. The largest slice is policy or terms of service disputes, indicating how platform rules often determine access. Next are algorithmic false positives, showing the significant role automated systems play in flagging accounts. Chargebacks and fraud claims add another substantial portion. Finally, technical outages and verification delays, while smaller, still contribute meaningfully. Altogether, these risks underscore the value of minimizing wallet balances. Quick knowledge check. The question is, are balances in many popular digital wallets protected by FDIC insurance the same way bank deposits are? The options are: 1. Yes, they are insured just like bank deposits. 2. No, they are typically not FDIC insured. 3. Only if you have used the wallet for more than 90 days. 4. Only for amounts under $1,000. You may pause the video now to think about the answer. Use guess. We will discuss the answer in the next section of the video. The correct answer is that they are typically not FDIC insured. In many cases, wallet balances do not qualify for deposit insurance protection. This is why experts recommend moving funds promptly to insured bank accounts, instead of letting balances accumulate in the app. For the second question, what is the pass-through principle? The options are: 1. Leave a cushion in your wallet to handle disputes. 2. Treat wallets as pass-through tools and transfer funds immediately to an insured bank. 3. Use multiple wallets to diversify risk instead of using a bank. 4. Only send money during business hours. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to treat wallets as pass-through tools and transfer funds immediately to an insured bank. The faster you move funds out of the wallet, the less exposure you have to freezes, policy disputes, or system errors. This strategy reduces the time your money is at risk. Let's cement the key takeaways. Treat payment apps as bridges rather than banks. Enable auto transfer and keep balances at zero. Recognize that wallet balances often face uninsured risk and policy-driven freezes. Keep your cash in insured bank accounts. Finally, document transactions and review terms regularly. Next, we'll wrap up with a concise summary and a final call to action. To summarize, payment apps are excellent for speed and convenience, but they generally do not offer the protections associated with banks. The safest habit is to adopt a pass-through approach and maintain zero balances in wallets. Protect your livelihood by keeping funds in insured accounts. Convenience matters, but secure access to your own money matters more. Before we conclude, let's finish with a quick reminder and invitation. Thank you for watching. If you found value here, please like the video, share it with someone who needs it, and subscribe for more practical finance content. Tell us your experience with payment apps in the comments, including any success tips or freeze stories, so others can learn as well. See you in the next episode.